So it looks like property values are kind of holding on and maybe making a little bit of an increase, like a rebound, but I don't think that really paints the entire picture of what's really and truly going on in the real estate market these days. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is the 28th of November. The month is almost over. The year is approaching the end. Hope you're doing well. Randy here, putting the realism back in real estate. So let's get into it right away. So here's the deal. This is the last Tuesday of the month. Typically, what happens during the last Tuesday of the month is called Case-Shiller Home Price Index gets released. So we're going to talk about that today. That's the topic of note. So U.S. home prices rose for the seventh straight month in September, led by Detroit. Of all locations, Detroit leading the way with the home price appreciation. So basically, seventh straight month of September. Remember that the Case-Shiller data is a couple months behind. So we're in November, and they're actually looking at the September data. So the calculation, the way it works, it's a couple months behind. Basically, that what we got here, it looks like the Case-Shiller was up 0.67% month over month, slightly worse than the 0.8% month over month expected. That pushes the year-over-year rise in prices up 3.92%, the fastest pace since December 22. But as the chart shows, the month-over-month gains are slowing rapidly. So again, we can take a look at things from a high-level perspective and say, oh, everything is good, prices are going up. But when you take a look at the micro level, it's not quite what it seems. Basically, year-over-year basis, the best performing metropolitans are Detroit up 6.7%, San Diego 6.5%, and New York 6.3%. Basically, we've commented before on the breadth of the housing market strength, which continued to be impressive on a seasonally adjusted basis. All 20 cities showed price increases in September. Very interesting. 20 cities across their 20-city index, of course. Obviously, nationally across the board is where we're looking at, the almost 4% increase. So, but judging by the resumption of the rise in mortgage rates, since the Case-Shiller data was created, we would expect prices to also resume their decline, which we can see that actually happening right now. Inventory is increasing. Home builders dump new homes in the market. Sellers are stuck. Affordability for the former and the mortgage cost gap for the latter. Despite the market's hope, the Fed isn't cutting rates anytime soon unless the economy utterly collapses. So be careful what you wish for is what's happening here with respect to Case-Shiller. So one of the things I want to talk about, and again, it's timing right now, guys. 10 ways to earn income and build wealth during the housing correction, housing crash. We'll talk about this towards the end of the video, but these are the 10 things that you can do right now. There's actually 11. We're doing all of these, and it's very interesting out there. So deals are there to be had. If you want to find out, let me know. So here is the S&P CoreLogic Case-Shiller Index continue to trend upwards September. This is their official, press release. So basically what they're saying is that, yep, we're getting a little bit of increase, 3.9% annual change in September, up from a 2.5% change the previous month. The indices are up a little bit as well, too. Nothing of note here, pretty pedestrian. We've commented before on the breadth of the housing market strength, which continued to be impressive. So basically what they're saying here is that the housing market is strengthening, is strong. On a year-over-year basis, the three best performing metros in September were Detroit, San Diego, New York. All right. San Diego presence breaks the Rust Belt's grip on the top three positions. The bottom three continue to have a Western flavor. Worst performers were Vegas, Phoenix, and Portland. Northeast and Midwest continue as the nation's strongest regions, while the rest remains the weakest. So interesting to see that. This is important, though. So when I talk about, it may not always seem the way it's portrayed in the media, which you know how I feel about that. So again, on a year-to-date basis, the national composite has risen 6.1%. That's the national composite, so the entire country has risen 6.1%, which is well above the median full calendar year increase and more than 35 years of data. Although this year's increase in mortgage rates has surely suppressed the quantity of homes sold, the relative shortage of inventory for sale has been a solid support for the prices. So unless higher rates or exogenous Events lead to general economic weakness. The breadth and strength of this month's report are consistent with an optimistic view of future results. So I circled the word suppressed. And here's what I mean by that. So, is this really a market that makes sense? Well, I don't think this is not a normal housing market. As a matter of fact, since COVID and the pandemic, we really haven't had a normal housing market, right? We've had an artificially inflated housing market for a number of reasons. Number one being the fact that people couldn't sell their homes and they're locked. Foreclosures and distressed properties were not on the market, so that removed choice of smaller or of discounted cheaper properties. So therefore, numbers went up. So essentially, in mortgage rates, so mortgage rates typically were 3%, 4% back in the day a few years ago. Now they're at 7 and 8%. So has that suppressed the quantity of homes sold? So yeah, so you're seeing homes that are being sold. You're seeing less homes being sold, but their price points are still high. So is that kind of skewing the outlook on the market here? Probably is. We don't have the volume, so we're not getting the mix of higher and lower end homes to sort of balance things out. So I don't believe this is a normal housing market. Now, I can tell you that, prior to COVID, and I've said this many times, we were bubbling prior to COVID. Foreclosures were increasing prior to COVID. When COVID hit, again, the foreclosure and eviction moratorium, lack of houses being sold, a lot of things happened in that time frame which changed the dynamic of the marketplace. So we're now kind of coming out of this change, but you've got the Fed messing around with interest rates. So therefore, we're having less homes sold. Even this is just the Case-Shiller is home price appreciation. It doesn't account for volume of homes sold. When we look at the NAR, the National Association of Realtor data, that accounts for how many units are being sold, and we know that the last NAR's data was very, very low. I think it fell under on a seasonally adjusted annual rate was just under 4 million units, which is 2.5 million units off the peak. So that's what we're looking at here. So again, as I say, higher price homes, higher mortgage rates, less volume, so it's probably skewing some of the values for sure. So one of the things that I always has mentioned too is the fact that real estate is so important to the general overall economy. And that's why you have people who are hell-bent on, this market's not going to drop, it can't drop, we have to have it at high prices, everything has to be more expensive. So when you take a look at real estate and what it contributes to the gross domestic product, it's massive. So I just Googled this, so Statista pulled this up, and this is a share of value added to the gross domestic product in the United States by industry. So that the first category is finance, insurance, real estate, rental, and leasing. All right. So if you think about that, it's making up 20% of the GDP. That's the largest sector out there. Obviously, where we got construction is down at 4%. All right. And you've got everything kind of in the middle. So real estate is in the section that contributes the most. So when I look at that, I sort of look at the economy and I say, well, that's why the housing market's being propped up. That's why lenders want to lend. Home Depot wants to sell you things. It's just price points are high because it contributes such a dollar value to the overall GDP of the country. So as I always said, like when you buy and sell a house, the amount of things that go on, the amount of we'll say people or corporations that touch the real estate industry is massive. You want to sell your house, you list it with a real estate agent. Real estate agent might do some marketing, okay? Real estate agent, buyer agent comes in. Buyer agent brings a buyer. Typically, the buyer has a mortgage or financing, so a mortgage broker or a lender or a bank is involved. Home inspections are done, appraisals are done, closing is done. So what happens when the property closes? Well, title company, escrow companies are doing title work and doing lien searches, and all that type of stuff is getting filtered through the system. Title insurance is being generated and applied to the transaction. So everything is cha-ching. Notaries are involved in signing up of documents. And then guess what? Seller's going to move. Seller's going to rent a moving truck, and off they go. Buyer, same thing. Buyer rents a moving truck. They come in. Oh, what happens? Well, you got to get pizza and beer for people helping you move, or you're paying money for the movers. All right. Oh, what's going to happen is, well, you're going to go to Home Depot or Lowe's or furniture stores. You're going to put things in the property. You're going to fix the property. You're going to paint it. You're going to have housewarming. You're going to buy appliances or small things and decorations. You're going to go to Target. You're going to go to Sears. You're going to go all over the place. You're going to do landscaping. You're going to buy lawnmowers. You're going to buy flowers. You're going to do all these things. So when you take a look at, what happens when you actually purchase or sell a home, the amount of touches that, we'll call it people that are earning income or entities that are earning income over a real estate transaction is massive. So that's why it's so important that, the industry is propped up with respect to what's happening in our economy. So just the S&P CoreLogic indices here. Obviously, we've got the 10, 20 city and U.S. National Index, which is the dark line, the thick line. You can see how it was peaking in 2005 and 6. It's dropping in 2008 and 9. It's that's our plateau area. Kind of peaked a little bit, dropped again with COVID, spiked up again, sort of after the pandemic and dropped as well too. So, it's been a bit of a roller coaster the past little while, but it kind of shows you how fickle the market actually is. This basically is the history of Case-Shiller from going back from 87. In the middle is our 2006-7, we'll call it peak. You can see the valley and the trough in 2011-12, and you can see how we were on a bit of a linear, higher linear pace growth model coming out of the last recession, and then it went exponential, a little dip, obviously, and we're sort of back up now. So that's what's happening in the marketplace from a chart perspective. Taking a look at the bar graph here, this is the dates for everything. So July 2006 was our peak, for the national. February 2012 was our trough. So basically, we are 69.2% on values from the previous peak. So from 2006 peak, we're almost 70% greater from home values. If you bought in the trough time frame, you're 133% above that period. So if you bought in the trough, you've more than doubled your money on the value of your house. So good for you, for people that have done that, but you can see where things are at. Listen, the market's unsustainable. We all know that. It's chugging along. It's being propped up. It's difficult. We have an affordability issue, right? Do we have a bubble? Sure we do, but it's more of an affordability crisis what we're looking at right now. If you don't believe that, I don't know what to tell you. The value or the volume of sales is down dramatically, so the average person can't afford a home. All right, that's the way it kind of works. So who's buying it? The wealthy, the elites, the people who are in different locations that are cash buyers, etc. That's what's going on in the marketplace right now from what we can learn from what's happening. Folks, if you enjoy the information I provide, if you could hit that subscribe button, I'd really appreciate that. And for those of you that are subscribers or think you are, do me a favor, hit the subscribe button, do the bell notification because I lose subscribers every day. I've plateaued for a couple of years now, so I appreciate you guys doing that. All right, let's take a look at the city by city here. So if we look at this, Atlanta up 4.3%, Boston 5.3%, Charlotte 4.7%, Chicago 6%, Cleveland 5%, Dallas 0.3%, Denver 1%, Detroit 6.7%, Vegas loses 1.9%, LA up 5.2%, Miami's 5%, Minneapolis up 2.4%, New York 6.3%, Phoenix losing 1.2% year over year, Portland losing 0.7%, San Diego up 6.5%, San Fran went up again 0.5%, Seattle up 0.9%, Tampa up 1.5%, Washington, D.C. 4.4%. So we can see that, according to September statistics, we've only got a handful. We've got 3 that went negative and a couple that really they're less than 1% year-over-year annual growth. So that's the kind of we're looking at the marketplace here. So, in some of these locations, you look at a Chicago and you look at a Cleveland and you look at a Detroit. Well, they have been historically low value locations for many, many years. So when I see a 6.7% for Detroit, that's interesting. That's good if you're in Detroit. But remember, their starting off point is much lower than the rest of the country. Okay, these were areas that were decimated in the previous housing crisis. A lot of these locations haven't recovered or still and have oodles of pre-foreclosure sitting there. And that's a point I want to make as well too. We're still not seeing the distressed property and the foreclosures, pre-foreclosures that make up the shadow inventory even affecting this market right now. So that's still being held back. The lenders aren't, even though it's slowly leaking, slowly increasing on a volume basis, we're still not seeing the huge amount that's out there that will make some changes into this environment. That's what I talk about all the time. So I know what's going on. We don't worry about retail, okay? If you want to buy retail, good for you. We can certainly help you with that, help you pay less for it. But the point, though, is that the retail market is slowing down. The people that need to buy or have to buy are doing that. Those that don't have to are sitting tight and will say just squatting in their own homes because they don't want to sell, because if they, again, if you sell and you have to buy something new, you're losing that 3% interest rate and having to pay 7 or 8%. Why would you want to do that? And your equity is just going from point A to point B. You're not actually gaining. So we call that a rate lock. People aren't selling because they know they're going to pay more on a mortgage. They don't want to do that at this point in time. So again, locations that are have been historically low are seeing some increases. Places like San Fran and Seattle and Phoenix and Portland, well, they've had some big time decreases already. So if we're seeing a little bit of increase there, yeah, we're probably seeing the remnants of the summer selling season. And then we'll see what happens as we go into the deep freeze of the winter selling months. We'll see what happens there. But again, as I mentioned, market's being controlled. If you don't think it's being controlled, you need to relook at things. It's been controlled since the last housing crisis. Our recovery was controlled. Lots of information about that. You just have to Google it and look for it on YouTube or other locations, other websites, etc. But it's very clear that the inventory was controlled back in the day, so we wouldn't have a plethora of properties on there pushing values down. Number one, and now two, as a quid pro quo on that. So if we can't do the volume and the inventory, then they're controlling the rates. So now it's like we're forcing people to stay in their properties and we're forcing people to overpay or to make it cost prohibitive to jump on that property. And at this point in time, we're not seeing sellers drop their home prices, even though there are reductions in home prices going on. We're not seeing the we'll call it the amount that has to be dropped substantially to compensate for those higher interest rates. That's kind of the situations we're looking at now. However, in every market, you have to take a look at what the opportunities are. There's many opportunities in this market right now, multiple niches. No one's focusing on these niches. Will it be just like the 2008 crash opportunity? I think so. We're looking at it right now. So what are you waiting for? And I always say, don't miss out on this once-in-a-lifetime opportunity to pick off properties at a much cheaper value. And don't miss out on a second chance at a once-in-a-lifetime opportunity if you did this in the last housing crisis, all right? And again, what I'm talking about here is not retail properties, right? For you to look on Zillow and MLS to find a deal, you're going to be pretty hard-pressed to find something that's going to make sense for you, and I get that. You got to go down the other path here, which is what we do. What am I looking for? Investor buyers, cash buyers who need single-family residential homes, looking for private funding partners for single-family home purchases and projects. I want to recruit real estate agents. We're growing now. There's so much out there. I just had a meeting this morning about new ways of approaching the marketplace. Recruit agents in the Tampa, Florida area. I'll show you how to do this, how you can double dip and learn how to invest at the same time. Looking for more joint venture partners, i.e. real estate investors who want to work with me on the distressed property stuff. I can do a lot of these deals for you. Bring me your distressed deals. We're very good at getting discounts, all right? Which moves me to, the top 10 ways to earn income and build wealth during the housing correction, housing crash. The longer this takes, the better it is for us, right? We look at foreclosure options, bank-owned REOs, short sale, short payoffs, taking property subject to homeowners association or condo association foreclosures, tax deed foreclosures, probate estate foreclosures, the zombie house stuff, right? I know the guy that has a zombie house show on A&E Network, all right? One of my properties is on that show. Underinsured, people who have issues with respect to storms or flooding or whatever that are underinsured that have to sell, and surplus or overage. That's, we'll get into that at a later date. So that's interesting, and something that we call as well novation / retail buying, where we're controlling the property, kind of like wholesaling, but a little more elegant way. So we're doing 10 or 11 things right now, all right? Reach out to me. I'll give you the information you need on that. As I said, I'm launching the new program now. We're doing some great discounts because it's starting now. Where I just had a meeting with people who want to do this on a larger scale, all right? I deal with a lot of big investor buyers, a lot of hedge funds, got a lot of contacts. So they're looking at this market, okay? People that have the money are not looking at retail and overpaying for stuff that's anybody can get their hands on. They're looking at the discounted properties, which is the area that I play in, all right? So if you want more information, There's my email. Connect with me. Let's talk, have a chat, and we can see how we can work together. All right. So thanks once again for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe. Look forward to speaking with you in a little while. Take care.